Well, office space stocks rallying in the months after the regional bank crisis, but a major chill may be in the air. Activist investor Jonathan Litt has been shorting this group. He's a chief investment officer at Land and Buildings. Jonathan, great to have you back with us. You thought after Labor Day maybe there'd be a push to back to office. Have we seen any of that in the data so far?
No data is confirming that. You see it in the headlines, but we just got the Castle data for last week. We look at the cell phone data. There's no evidence that we have more people back in the office.
Okay. So before you came to us with a short on Alexandria Realty, ARE, are you still short that name? And what are you seeing there? Because you were citing specifically the cell phone data that you were tracking within the buildings and how long people were actually there.
Right. And it's going to be very challenged for a long time, the office lab space. And we don't see it changing anytime soon. In fact, for the whole office space, it's going to be challenging. But for them in particular, they're expensive stock. They have very little leasing activity. They have a lot of space. They're trying to get let, and they're overvalued. And we think it's going to be quite a challenge. Are
there any new shorts that you put on in the office space? In other words, has anything gone to the point where it looks worse? Maybe they have debt repayments due with a closer deadline versus 5 months ago.
When we were here last, it was pretty washed out. We said there wasn't much market cap left in the space. Alexandria is really the best one today. A lot of the stocks have run and rallied off the bottom, but we think they're going to retest some of the lows in the coming months.
I'd ask the question a little differently, just sub-sector, though. In other words, in terms of some of the commercial corners of the place. Look at the insurance world. Think about what's going on some of there and some of the places where liabilities and the dynamics in the core business are changing so much. Is that illuminating anything different?
What, in the office space?
Yes.
Or, well, look, we talked about return to office. It's not about return to office anymore. It's about financing. We have $400 billion coming due over the next several years. We cited Newmark, says they're 80% LTV. You can't get 80% LTV loans. So there's going to be a cold winter for office as we get through this refinancing wave. Stocks are trading at a 10 cap rate. That might look cheap by the time this is done. And that might look expensive. They might get even cheaper as we roll through this.
How big a deal with that is the Fed's path? So we have about 100 basis points of easing priced in the markets for next year. If we don't get that, if we get half of that, of all the factors that matter here, with all that debt coming due that needs to be refinanced, how big a role does the Fed play, or is it not a big deal?
I mean, for the Fed to solve the problem, rates would have to go back to where they started raising, because you have the work from home phenomenon coupled with the high LTVs, and I just don't see an easy way out.
When we say $400 billion in loans due from now till year-end 2025, how does that play out? How do you dissect that data? Are there sectors that are more vulnerable than others? Are there areas, locations, cities?
So that's just office. I mean, San Francisco is going to be very difficult. New York's going to be difficult. People are going to give the keys back. It's going to be the easiest path. About half of that is with banks. The other half is with debt funds, CMBS, insurance companies. Some of those have written it down. Some need to write it down. That won't impact the banking industry. There's $200 billion that will. And I think that's going to be digestible. That's not going to go to zero. That'll go down some amount.
We had a clip from Jamie Dimon talking about how banks were not investable in his opinion. I'm not asking you to pick stocks, but what do you think of the banking sector right now, given everything that you look at through your lens?
I'm not really a pro. I would be speculating.
But you watch it.
I do watch it. And, I just don't know the balance sheets well enough to talk about which banks might be at risk from this. I clearly read the papers and see what people are speculating on, but I'm going to stay in my wheelhouse. But, I would say, there's a lot of press on office and how bad real estate's going to be, and they just paint it with a broad brush. If you're looking for distressed real estate, which investors are, the best place is in the public markets. Private equity firm after private equity firm that I talk to, they can't find distress in real estate. If you want to own single family for rent, warehouses, senior housing, you could get it on sale in the public market. So it's important to distinguish between office, which is going to be very challenged, and other sectors that are in really good shape and are very investable. We had 2 large M&A transactions about 3 weeks ago in the REIT space. Huge premiums to where the stocks were trading. I think that's going to continue. As capital comes back, these private equity guys have money to put out, and they're going to take these companies private.
Last question. What's your highest conviction long in your portfolio?
Highest conviction long today would be Ventas. Okay. It's a senior housing REIT. Trades at about a 6.5 cap. Its closest competitors are 4.5. It's a bit broken right now. We are looking to get some change done at the board level. And we think if they can make better decisions on capital allocation, run the portfolio better, the stock should be a home run. The senior housing business, let me just say, is probably the strongest real estate sector today with the elderly moving into these facilities.